Hello friends, welcome back, and I am Santosh sir, and in this video I'll be sharing the solved assignment of MCO 05. Basically there are two numericals in this assignment, and many of the students, they are in confusion what should be the answer of these numericals, because theory part is okay, you can write, but numerical part little bit confusing. So friends, let's start with the first question, and the first question is on cost. The question is, cost may be classified according to their nature and characteristics. Explain. So indirectly what you have to do, you have to write the different types of costs, and these are the main categories on which we can divide the cost. We can divide it on the basis of functions, on the basis of identity, on the basis of variability, on the basis of controllability, and on the basis of decision making. So these five categories you can use. Again, all these categories are subdivided. Like on the basis of functions, we can divide the cost into manufacturing cost, administrative cost, selling cost, and distribution cost. Similarly, on the basis of identity, we can divide the cost into direct cost and indirect cost. So all these costs you have to explain their meaning, write 2, 3, 4 lines about this. Then on the basis of variability, we can divide the cost into three types: fixed cost, variable cost, and semi-variable cost. Like that, on the basis of controllability, the cost can be controllable cost and uncontrollable cost. So like this, on the basis of decision making, we can divide the cost into three types: differential cost, sunk cost, and opportunity cost. So this is the answer of the first question. Question number 1, part 2. State the conditions under which the income statement prepared with absorption costing and marginal costing. Right. So this is little bit very unique type of question, and the solution is, I think, not there in the study materials of IGNOU. Okay. In absorption costing technique, no difference is made between fixed and variable cost while we calculate the profits. Absorption costings assumes that fixed cost attached to the products, so that all the production cost, whether fixed or variable, should become a part of the production cost. Whereas in case of marginal cost statement, it offers an alternative layout to the traditional income statement prepared under absorption costing, and it treats fixed and variable cost separately while calculating the profit. And the main difference between these two types of costing, like in absorption costing, is it's bit challenging to implement, whereas marginal costing, it's simple and traditional. In absorption costing, contribution per unit is considered, whereas net profit per unit is considered in marginal costing. Absorption costing emphasizes overhead recovery, whereas marginal, it gives more importance to units contribution. The primary consideration is given to the cost of each unit in absorption costing, whereas in marginal costing, the cost of producing the next unit is given more priority. So like this, question number 2. You have to write the differences between fixed cost and variable cost. I think this is simple. You know about this. We have read many times about fixed cost and variable cost. Then comes differential costing and marginal costing. So I have written here 3 points. You can expand, you can write more. Marginal costing, it considers the change in the cost in order to produce an additional unit of output, whereas in differential costing, the difference between the cost of two alternative decisions or production techniques that can change the output level, that is considered. The purpose of marginal costing is to evaluate whether it is beneficial to produce an additional commodity or not. But in case of differential costing, the evaluation is the most suitable option between the alternatives. Marginal cost is compared with the marginal revenue to calculate the impact of the decision, whereas cost of two scenarios are compared and less costly alternative is selected in case of differential costing. The next difference is on CVP analysis and break-even analysis. CVP stands for cost volume profit analysis, which is used to determine the sales volume required to achieve a specific profit level. Whereas break-even point is reached when total cost and total revenues are equal. That means the firm is incurring neither profit nor loss. CVP is a broad concept, but break-even is a subset of CVP analysis. That means CVP is the parent and break-even is the part of that, a child of that. The CVP formula shows us the sales volume needed to cover the cost and the break-even, but BP helps to determine how many products or units are needed to achieve a desired profit. The next difference is on cash budget and master budget. Now cash budget, as you know, generally it is prepared for cash inflow and cash outflow during an accounting period. Whereas master budget, it is the financial forecast that consists of all the types of revenues and expenditures during a given period. And the cash budget is a component of the master budget, whereas master budget, it is a big concept, and cash budget is only a part of master budget. Net result of master budget is referred to as net profit or loss, whereas the net result of cash budget is referred to as surplus or deficit. So like this. Then comes question number 3. The trial balance is given in the question, and there are little bit adjustments, additional informations are given, and you are required to prepare profit and loss account and balance sheet. Okay, now let me tell you that this question is there in the study material of IGNOU. So you can write the answer of this particular question from the study materials which has been given to you. Now this is the profit and loss account which you should prepare, and then comes the balance sheet, right? So simple question, not much in that. We know about financial accounting and how to prepare trading and profit and loss and balance sheet. So I hope you can do this by your own. Okay, question number 4 is on this material. You have to find material variance, material uses variance, material mix variance, and material yield variance. Now I have prepared the solution of this. Now here you first of all what you have to do, just jot it down like what information is given in the question. First, this actual production is given 369 kg, standard loss is given 10%. So first find out actual output. So when the loss is 10%, so 100 upon 90 into 369. So that will give you 410 kg. So this is the actual output, and standard quantity again it is given 40%. So 40 find 40% of 410, you get 164 kg, and this commodity Q 60% of 410, that will fetch you 246 kg, right? Now when you calculated all this cost, now let's find out the first question, material price variance. The formula is standard price minus actual price into actual quantity. Standard price that is given in the question 400, actual price 680, subtract this two, you get 180, and the answer will be 50,400 adverse, that means negative. This is for commodity P, and for commodity Q again you use the same formula, standard price minus actual price into actual quantity. So here for Q the result is favorable, that's why you should write F here. The second part of the question is material uses variance. For this we use this formula, standard quantity minus actual quantity into standard price. This is also adverse. Standard quantity is 164, actual quantity 180, subtract these two and multiply it with 400, you get 6,400 as adverse. This is for material P. For material Q, again you will subtract both standard quantity and actual quantity and multiply it with standard price 600. So again this is favorable. To calculate material mix variance, uh, now this is little bit tricky, mix variance. Here we use this formula, revised standard mix minus actual quantity into standard price. Okay, now again you have to find revised standard quantity. To find this thing as a revised standard quantity, again you have to use this formula. Okay, standard quantity divided by total standard quantity into total actual quantity. Standard quantity, as we have calculated, 40% of 410, that is 164. The total standard quantity is 410 into actual quantity, that is 400. So you will get revised standard mix as 160 for material P. Now again you will use this in this formula to calculate material mix variance of P. 160 minus 180 into 400. Okay, and the same thing, like similarly you will work out for commodity Q. To calculate material yield variance, again use this formula, standard yield minus actual yield into standard output price. Now again you have to find standard yield. Standard yield is actual uses of material divided by standard uses per unit output. So actual uses of material is 369, which is given in the question, divided by standard uses per output, that is 410 divided by 1000. So when you will divide these two numbers, you get 900. And standard output price, that is 400 into 164 plus 600 into 246 whole divided by 1000. 1000 because 1000 kg is there, so you have to divide by 1000 to get 1 unit output, 1 kg output. So that you will get 213.2. Now again you can use this in this basic formula to find material yield variance. Okay. Question number 5, explain how the variance analysis relating to overheads differ from relating to material and labor. So again a little difference is there. So overhead variance analysis is different from variance analysis in the following ways, because the overhead is considered in terms of predetermined rate applied to the input, and there can be different bases for absorption overheads like labor hour, machine hours, output units, like that. Overhead variance may be classified into fixed and variable overhead variance, and fixed overhead variance can be again can be divided into different types. In case of variable overhead, it is assumed that the variable overhead vary directly with production, so that any change in the expenditure can affect the cost. Okay, so like this you can write differences between the both the overheads. And the part B of the question is, in what way we can analyze sales variance, explain in detail. So to analyze sales variance, we use these important methods, that is sales value variance, sales price variance, sales volume variance, sales quantity, and sales mix. So again you will write about this, all these methods, like for sales value variance. Now basically it is the difference between budgeted sales and actual sales, right? And to calculate budgeted sales, we use this formula, budgeted quantity into standard selling price, right? And for actual sales, actual quantity into actual selling price. So you will get sales value variance. Then comes sales price variance, and in this again we use this formula for sales price variance, actual quantity into standard selling price minus actual selling price. Now to find standard sales, again actual quantity into standard selling price, and to calculate actual sales, actual quantity into actual selling price. So like this, to calculate volume, we use this formula, this particular formula, standard selling price into budgeted sales volume minus actual sales volume. And again also write the formulas of budgeted sales volume and actual sales volume. To calculate sales quantity variance, we use this formula, this particular formula, budgeted sales minus revised standard sales, And to calculate sales mix variance, we use revised standard sales and standard sales. So friends, these are the like solution of this, and there may be some errors in the calculation which are always subject to corrections. So friends, complete your assignments and get maximum marks. So that should be our motto. And thank you very much for watching my videos. Kindly like, subscribe and share.